Today, I want to talk about how the banks may not have enough money to pay for the squeeze and could potentially be hiding trillions of dollars in losses. I also want to talk about how those same banks are currently pumping Nvidia before the big crash. So stay tuned and let's make some money. I also wanted to announce the mid-year sale at the Millionaire Mindset Trading Group. Just use code MIDYEAR, all in capitals, at checkout for $100 off the price of the lifetime membership or 25% off the price of the monthly membership. And that goes perfectly with today's 215% gainer. But let's dive straight in with the key information. So, Peruvian Bull has tweeted saying the banks don't have a way to unwind the massive derivatives monster they've created. He's shocked. Now, I'm guessing Peruvian Bull being shocked is sarcasm, but this CNBC article says that banking regulators on Friday disclosed that they found weaknesses in the resolution plans for 4 of the 8 largest American lenders. It says the Federal Reserve and the FDIC said the so-called living wills of Citigroup, JP Morgan, Goldman Sachs, and Bank of America filed in 2023 were inadequate. It says regulators found fault with the way each of these banks plan to unwind their massive derivatives portfolios. Derivatives are Wall Street's contracts tied to stocks, bonds, currencies, and/or interest rates. Now, I will go through this full article in a bit more detail, but Kristen has posted some very important, very simple questions that are currently unanswered. So it says regulators are finally asking JP Morgan, Goldman Sachs, Citigroup, and Bank of America important questions about their trillions in derivatives, especially their interest rate derivatives and total return swap contracts. She said it would appear some market-savvy bank examiner embedded at one of those mega banks had an epiphany and decided to ask a very important question. Now that question is, how is it possible that all 4 of these mega banks with trillions of dollars in derivatives happen to be on the correct side of these trades during the fastest and steepest interest rate increases in 40 years? Or for a better question, where are these losses on the derivatives contracts? For any kind of trade, there's 2 sides to each trade. Somebody makes a profit and somebody makes a loss. Now fine, maybe all 4 of these banks have made profits on their trillions of dollars of derivatives contracts, but where are the losses? It says multiple bank counterparties to these trades should be reporting massive losses over trillions of dollars, and yet all we hear is crickets. We know Goldman Sachs, JP Morgan, Citibank, and Bank of America have hundreds of trillions of dollars in derivatives contracts, but where are the losses on these contracts being held or being hidden? Maybe they're being hidden overseas, and if so, how long is it going to be until one of these banks ends up cracking and ends up collapsing? And now explaining the article in more detail, it says, for example, when asked to quickly test Citigroup's ability to unwind its contracts using different inputs than those chosen by the bank, the firm came up short. It says every other year the largest US banks must submit their plans to credibly unwind themselves in the event of a catastrophe. So it seems these 4 banks cannot credibly unwind themselves and would cause massive damage to the financial system. It says JP Morgan, Goldman, and Bank of America were all rated with a shortcoming, but Citigroup was even worse and considered a more serious deficiency. This is massively worrying if some of these banks or one of these banks is hiding trillions of dollars in losses. And as I said, more worryingly, begs the question, how much damage would this do to the financial system? And as you can imagine, it seems the short sellers are more scared than ever right now. As Jim Chanos has said, we now need short sellers more than ever. Jim Chanos is literally trying to recruit more short sellers and trying to recruit more people to short these stocks like AMC and GameStop. In this interview, he's even specifically talking about meme stocks and the damage they're currently posing or damage they're currently doing to the stock market, which really to me shows just how close we are to the squeeze. If we're now at the point short sellers are begging for more help in shorting these stocks, it shows me their time is running out. Jim Cramer, quite some time ago, also posted this video on how you can actually crush the short sellers. As I touched on earlier, I wanted to go through the 215% gainer and the 50% gainer we had today in the Millionaire Mindset Trading Group. So as you can see in the pre-market, I said that I was watching AGFY for the breakout of 50 cents and MLGO for the breakout of $5.20, which is a 2 for 2, 100% success rate today. We can see MLGO broke through $5.20 and continued running during the market hours all the way up to highs of $16.40, and Harhan locked in 140% gains. And on AGFY, we also got that 50-cent breakout, which ran to highs of 73 cents. Arif bought in at 48 cents and sold a little bit early at 55 cents, but still managed to lock in those gains. So guys, be sure to use the code MIDYEAR, all in capitals, at checkout for $100 off the price of the lifetime membership or 25% off the price of the monthly membership.
You buy the stock and buy it and then buy it some more and then continue to buy it and your friends do the same thing, then you can sometimes crush the short sellers simply by vacuuming up all the shares that the shorts need to borrow if they want to make.
Now you may be saying, well, Tom, this is what we've been doing over the last 3 years, buying and holding both AMC and GameStop, but the squeeze hasn't happened yet. Surely this can't be the way to cause the squeeze. Now to that, I would say this absolutely is the way to cause the squeeze, and it happens every single day with some of the fast-moving momentum news plays. But AMC and GameStop are different to these small cap stocks for one key reason. Now, as an example, today, in total, MLGO ran from $4 to over $16 per share for a 400% gain in one day. Today, the short sellers were trapped and demolished by retail investors in MLGO. But why did it happen today in MLGO and not in other stocks like AMC and GameStop? Now, the prime reason is because in MLGO, there's no synthetic shorts. There are regular short sellers that today got crushed, but there's not hundreds of billions or tens of billions of shorted shares. There was just multiple millions of shorted shares. So therefore, it was much easier for retail investors to come together to crush these short sellers in MLGO because there wasn't billions of synthetics. Obviously with AMC and with GameStop, because there's billions, tens of billions, maybe even hundreds of billions of synthetic shares, we need way more buying pressure to crush those shorts. Now, on the days we saw massive price gains on GameStop, over $40, $50 and $60 per share, it's because there was hundreds of millions of shares traded in just one day. At the peak, we saw 279 million shares traded and also 206 million shares traded in one day, which is massive compared to the volume we've seen every day over the last few years, where usually we just manage a few million shares traded. When there's that kind of significant trading volume, the shorts can't handle it and the price starts spiraling out of control. With more buying volume, let's say 1 billion shares traded, that's when all of those shares would be scooped up, like Jim Cramer says, and the shorts would be destroyed. Now, Jim Cramer has also revealed the dirty tricks that short sellers use to manipulate these stock prices down. I won't go through the entire video, or I won't show you the entire video, just show you the key points.
You can't create yourself an impression that a stock's down. But you do it anyway because the SEC doesn't understand it. So that's the only sense that I would say this is illegal. But a hedge fund that's not up a lot really has to do a lot now to save itself. So what I used to do was called, if I wanted to go higher, I would take and bid. And if I wanted to go lower, I'd hit an offer. And I could get a stock like RIM for maybe, that might cost me 15, 20 million, Annie, to knock RIM down.
It's crazy, as Jim Cramer says, these shorts can commit these illegal crimes, but they don't care because the SEC doesn't understand them and doesn't understand what they're actually doing. As a prime example, many think these banks are trying to pump Nvidia before the big crash. We're seeing analysts upgrading price targets left, right and centre for Nvidia to $150 per share from $135. Again, we've seen this pretty much every single day and every single week over the last few months. Analysts are upgrading price targets every single day. We're also seeing articles titled, "This is not the dot-com bubble and Nvidia's valuation is still compelling," says Bank of America. When it's likely, in reality, these banks are preparing to sell it all today at the start of the big crash. At some point after such a massive gain in the last few years, Nvidia will experience a big 25-50% pullback or even larger. And at that point, the analysts will be telling us Nvidia is still a buy, while these hedge funds and banks are selling everything, ready to buy back at the lows. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.